Welcome to the Rim Break Rodeo. We hope this video helps.
The Nifty 50 represents 50 large-cap Indian companies and sets market direction. You can invest in Nifty via three main vehicles: index mutual funds, exchange-traded funds, or futures and options contracts. Index funds and ETFs replicate the index weightings to match performance. ETFs trade on exchanges and settle like stocks. They carry expense ratios commonly between 0.05% and 0.5%. Choose an ETF for intraday trading and an index fund for automatic systematic investments. Futures and options provide leverage and higher risk compared to funds. First, open a demat and trading account with a registered broker and finish KYC verification. Second, decide whether you want an index mutual fund, an ETF or futures exposure, and choose lump sum or a SIP with a typical minimum of Rupee 500. Third, for ETFs, place a buy order on the exchange with market or limit price and specify quantity in units. Fourth, review expense ratio, tracking error, bid-ask spread, and brokerage before confirming the trade. Understand costs and taxes before you buy to avoid surprises and to plan returns. Equity-oriented long-term capital gains above Rupee 100,000 are taxed at 10% without indexation. Short-term gains on equity instruments held under 12 months are taxed at 15%. Expect brokerage fees, fund expense ratio, and possible tracking error to reduce returns. For futures, use margin carefully and apply stop-loss orders to limit downside.
Thanks for watching. Consider subscribing if we helped you.